There we go. Oh my god. It's like, how crazy can it get? Okay. Nope, you go away. Just trying out that guy. Did not want it. So we are here. Nope, nope. Alright. Shh. Don't look. Actually, I want to correct. Alright. Okay. Okay. So, stock market. Market price. That's probably okay. Federal Reserve News. Here we go. So, okay. So, what I really kind of wanted to point out, which is really something kind of funny about the stock market, and we'll look at the S&P 500, that's fine. So, today, stocks are up a little less than 2%, right? So here's the last couple of days. Let's go over the past month. Okay, that's actually a lot better. So basically, what happened, and here's the story. Things are just kind of going up and down like the stock market does. And back in the middle of last month, the market knows that the Federal Reserve is going to announce whether or not they're going to increase the interest rates or lower them. So the market and the market makers start getting ready by selling stock off and making the price decline over time, right up until about the 27th. So, but then somewhere around the 27th, the Federal Reserve board members start hinting that they're not going to increase rates. So let's see what they said. So on their actual statement on November 1st, this was yesterday, recent indicators suggest that economic activity expanded at a strong pace in the third quarter. Job gains have moderated since early in the year, but remain strong, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. In support of these goals, the committee decided to maintain the target rate range for the federal fund rate at 5.25% to 5.5%. The committee will continue to assess additional information and its implications for the monetary policy in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the reason why this bounced back as quick as it did, as you can see, straight through the roof, and over the past few days, it's just been climbing extremely rapidly over the past few days, is because these agencies are trying to determine the accurate price of a stock. And so what they use is something called the Treasury fund rate. Treasury funds. There we go. Treasury direct. So what they do is they use these investments. Go to Treasury bills. Actually, where's a 10-year bond? That's what they really use. See all rates. This works. Actually, this is probably a good show and tell right here. I guess I go to bills. Bills should only be up to 1 year though. Anyway, so what the idea is that if I can go to the federal government and get a bond that's going to pay me a percentage or a certain rate, and usually they use the 10-year, not the 20-year. This is just the last guy sold here. So on the 10-year, essentially what people assume is that the federal government, the U.S. federal government, is incredibly safe, and so there is no risk to buying bonds up to a certain time frame for your investments, because essentially for two reasons. If the U.S. federal government just absolutely falls apart, every other investment doesn't really matter. And as opposed to other investments, say like the stock market, if you're investing in real estate, if you're doing those things, because take for example, real estate's a really good example. Let's say the federal government just collapses altogether. And you decide, hey, I'm going to go evict the tenant. There's not going to be a police officer or a court system to go evict that tenant. So I guess if you really were adamant about going out and evicting that guy, you could do it yourself. But we're not in that situation, and that probably wouldn't be the safest thing to do anyway. So investors look at this and they say, hey, so for example, if let's say I was looking to invest in, or if I was looking at an investment, if I were to walk in and say, hey, look, the government is currently going to give me 5.27%, and I know that they're going to pay that percentage rate. So let's pretend that that is 100% guaranteed, even though we know it's not, but I'm sure that's how some people think. We're going to say, well, I can get a guaranteed 5.27%, or we go back to the investment stuff, and let's pretend this is just a 1 year. Okay. With all of these ups and downs going on, how well would I prefer to ensure that I can get that guaranteed percentage rate, or I'm going to take a risk that, well, maybe it goes up, but, if I bought, go back a little further, if I bought back here, what's going to happen to my investment over time? Now, over the long run, wait, what am I looking at? This is S&P. Oh, that's GSBC. Okay. We'll go back here because that's not very fair to say. But essentially, over a longer period of time, yes, generally it has continued to climb. But these little price variations, you have to understand, this long line, like from here to here, so for example, from 2019 to the end of 2023, that represents the overall productivity of the United States right now. These little bumps are just the bets that are going on between Wall Street, big banks, and big insurance companies. And so if you're an investor, and you're a long term, you're going to invest for long periods of time, then hanging out in the stock market, probably not a bad idea. But make sure you either need to know what you're doing or learn what you're doing, or you need to go find someone who does know what they're doing. Or what you can do is that if you feel that you're just going to invest for a shorter period of time, and right now, because rates have come back, whether through bonds or CDs, what are CD rates right now? Nope. So these guys are saying 6%. That doesn't look quite like that. I don't know. We'll say between 5 and 6. Yeah, it looks like they're trying to sell stuff at 5 or 6%. Whether I assume that's true. Let's just assume that's correct. But, I don't know. If it's a 9-month offering, that would be about 6% over the course of the whole year. But in either case, you can either invest in something a little bit more aggressive, but you're going to get a lot more ups and downs, or you can invest in things that are considered relatively more safe. And the last 14 years have been wild just because, interest rates, chart, interest rates have been super, super low. So the bond market has been basically dead. See, interest rates, past, let's do 30 years. Give me pictures. Yep, here we go. So, yeah, as you can see, this was a spike due to the oil crisis back in the day. But as you can see, like mortgage rates have actually consistently, slowly come down over time. One of the major reasons, I used to see 2008, it literally just dropped off the edge of the cliff. A major reason why this is going on is because as the US dollar gets deflated, interest rates tend to go down because there's more money running around the system. So banks are competing with each other with more dollars to see who's willing to invest in different investments, which is why historically real estate has actually been a really, really good investment if it's managed properly. Just because if I can go borrow at 3%, which is essentially free money, and I can get a return on my investment at 7 or 8%, you're just taking money from the bank and then you're moving it to a real asset. And like I said, if you're managing it properly and the home prices have gone up, you can do really, really well. The issue is that real estate, my personal take on that is that real estate, do not treat real estate like an investment. You have to treat it like a business, because if you treat it like an investment, you're not going to take care of it. You're not going to be over there on top of tenants where they're not paying their rent. You're not going to be fixing things. You're going to cut corners because you'll play the game of, hey, the price is always going to go up, which it absolutely does not always go up. It's very localized. Some areas, got hollowed out in 2008 and never came back. But it's very, very dependent upon where you live, and you need to understand that market. And you also need to set yourself up in such a way that you're buying that property at a steep discount. And I've watched it over and over again in my life. You get guys who do like real estate fix and flips, the like HGTV fix and flips. Or whatever TV show like made it super popular. Well, we're going to make a ton of money investing in real estate. Well, most of those don't actually make any money. So for example, here's a perfect example. Here we go. That's a good picture. Okay. Here's the thing. You want to buy houses that look like this and then turn them into houses that look like that. That's a perfect example of what you should be doing in real estate. Far too often, I see people do, this irks me. I've seen people pull this crap all the time. I've literally had real estate agents send me pictures of like, hey, you want to invest in real estate? We got this great property. And the property will look like this. And I'm going, there is absolutely no money. There is no money to be made as an investor in something like this. Which is kind of interesting. The hedge funds buying real estate 2023. Here's 2023. Let's push it forward. Cerberus, Reuters. So you've very likely heard that these hedge funds have been running around buying up these real estate properties, and they are 100% making this mistake. They're buying properties that look like this, right? And if hedge funds are buying a whole bunch of properties that look like this, you have to realize, first off, the guy running the hedge fund they are not going to come up and fix this property, okay? So when tenants damage things, when things fall apart, when, they can get on the phone, sure, and call the maintenance guy and have him take care of the little things, but there is a real skill set in understanding your market, which absolutely anything you invest in, like I said, you need to understand the investment, or you need to find someone who does. and then focus on making a lot of money and controlling your expenses. That seems to be a lot more practical way to make investments. But for example, here we go. Real estate investors pulled back, buying 45% fewer homes than a year ago. Well, yeah, no kidding. So let's see. Drop in investor market share is down 16% after hitting all-time high. 20% in the first. So investor market, they're buying 20%. Is that what I'm supposed to? Is that what I'm saying? Market investors down. Yeah, so they're buying up 20%, and now they're only making up 8% of the listings. Because the issue is, because where's prices? Investor market share. Like you can see, like, yeah, usually a normal real estate market is not up here. A normal real estate market is actually probably down here, closer between the 5 and 10% range. This happened for a lot of really bad reasons. And then, of course, the money got super cheap. And, of course, guess what? You're getting money from the banks, and then you're investing it in real estate and real asset through arbitrage. Made it really popular. Well, like I said, this happened because interest rates were basically zero, and you could get free money. But the issue is now, because of all that free money, and I wonder if they have... Let's see... Here we go. All right. Okay. Check it. Well, where's the graph? Okay. So, think about this for a second. If you're a hedge fund manager and you have a bunch of investors sending you money in order to invest in real estate, that really took off towards that big head. There's always been there's always been hedge fund managers investing in real estate, but most of the time they're in commercial real estate. But look, as home prices have kind of gone up considerably over the last few years, here's where the pandemic was hitting. Prices flew through the roof. But guess where these investors started buying? They weren't buying back here. They were buying here. And here's the issue with this. Okay? When you see these really big rollovers in markets, like for example, if you come down here, like look right here, notice it's kind of hard because this thing's popping up. So up here, you notice this big spike. Okay? Now obviously when you're zoomed out, it looks smaller because you get these bumps perspective-wise. Here's a better, easier way to see it. You see this? Okay? That right there is a bubble. That is exactly what that is. So home prices come up. For whatever reason, that was right before 2008. They spiked up through 2008, and then it takes about 18 months and they fall apart. Okay, from the peak, 2007, it takes about 18 months for real estate to fully fall apart. Okay, so from quarter one, so then 2008, guess what? It takes till about 2009 to fully bottom out. Beginning of 2009, well, that's the full quarter information. So, like I said, about 18 months to 2 years. Okay, come through here. What do you think this is? That's a bubble again. So if history has anything to say about this, or at least through the past couple of bubbles, and this was the .com bubble. So guess what? Spike, drop, stays flat for about 18 months, right? 18 months to 2 years. Guess what happens here? Spike, drop, 18 months to 2 years. Spike, well, we are still not all the way there. We're only about a year in. So if history is any measure, I would argue we need another 6 months to a year for this to fully come back to where it should be. The issue is, for example, you see these bubbles coming back. This, if it was where it should be, would be back down here. Okay? So, and obviously this largely depends upon the region that you're in because people shift around and move around a lot. And so this from here to here may be representing like San Francisco, maybe representing New York, or maybe Florida, maybe Texas. So it's very local, but yeah, there's no way I'm flying. I would be very, very, very patient if I was playing the real estate game right now. Because if you take a $25,000 hit in real estate, that's probably not that big of a deal from just market loss. As long as the house is taken care of, you got good tenants, you have good upkeep, everything else, good cash flow, not a big deal. But even if you have the most amazing cash flow in the world, if you took a $150,000 hit, yeah, you're screwed. Especially the hedge funds, because God, their investors are, ugh. I'm sure as soon as they see that nastiness, they're just going to want to bail on the investments, especially single-family residential. I mean, you can make money flipping residential. Real estate's crazy too because people talk about making all this money in rental properties, like the single-family home residential properties. If someone says they're making money on multifamily or something like that, absolutely understand it. But whenever I've looked at numbers for single-family residential, the most I think I've ever seen anyone ever make with a loan was around $700, I want to say. But usually it's way lower than that, and most people buy it wrong, so they end up investing in nonsense, and they're losing money every month thinking, oh, with my negative cash flow, I'm going to make all this money. Nope, absolutely not. But no, but those investments are just wild. Don't care. House gears up to one of the Israel. Don't care. Well, I do care. I just want to talk about it on here. Okay, so dropping a little bit. Apple Holiday. Yeah, no kidding. Is anyone buying the new Apple phone? I ride mine till it's broken. Yeah, everyone's striking now. Of course, it's because Canada's turning to communists. Goldman Sachs to promote 608 to managing directors down from 2021. Okay. Oh, this is going to be... That's an important deal. What else? Nope. Concepts of it. And Starbucks continues to grow. Everyone loves their coffee. Here's another thing to talk about too. That's something I probably should discuss. So, okay, this is why I say this is actually super important. So, especially in tech, in businesses, whenever you're starting a business, cash flow is king. If you are not making money in that business, eventually it is going to fail. However, most businesses take a period of time before they're going, there's a period of usually about 3 years in which you're not really making money in a business. Sometimes it's just because your skill set's lacking. Sometimes because it's just the growth of the company. It's like the capital investments. So once you hit the cash flow break even, basically what it means is that your income is now equivalent to your expenses. And so once you hit that point, once you're at cash flow break even, the company can theoretically survive indefinitely, but obviously you want to increase those margins or otherwise investors are not going to invest in your business. Because the break-even point runs the business, the profitability is going to pay your stockholders. So that's actually a pretty good thing for Elon Musk. But he is crazy good at business, and by the end of his life, he's going to have multiple companies on the stock market, which is wild. I mean, most people can't even get one. Most people can't even get a business off the ground. He cotton like. So he's got, because he did PayPal, and then they went into Tesla. They've got, they got the rocket company, and now he's got Starlink, and so, yeah, SpaceX. That's the one I'm thinking of. Okay, should not. Okay, here's another crazy one that is kind of going on. Now, what's kind of crappy about this is this. Is this actually what she said? I don't know if I'm not going to go watch the speech because I'm too lazy. But one of my major issues with kind of this, how this is like in newspeak, and I think is Reuters right wing? They're probably more right wing. Anyway, this title says to me that there's this weird game people are playing, which you say, hey, I've got to either choose between the United States or I have to choose between China. On a global stage, you would want, as a country, as many allies as you possibly can. And economically, you want as much free trade between every country you possibly can. The issue that they've had with China in particular has been that China will steal people's intellectual property and then run the people out of business and just sell your stuff as if it's their own. Now, I understand that as a business, this is absolutely not anything you want to do, which is probably why there's been a lot of companies that have started avoiding China and they're not going to deal with China, because if you're innovating and developing something in the US or Japan or Europe or wherever you're developing it, and you spend huge amounts of money to patent and create a product, why would you take that product to a group of people that are just going to steal the intellectual property, throw you out of the business, and then just keep it for themselves? Like, that makes absolutely no sense whatsoever. No one's going to do that. But China has all of these, despite the fact that China has grown significantly, one of the major issues with China, how many patents? I wonder how many. I don't know. Let me see this. Okay, so you get articles like this, but so for example, China leads 37 to 44 areas that track with a potential monopoly in areas such as nanoscale materials, synthetic biology. Okay, so this right here it's probably a little misleading, because a lot of the issues that there's two real main issues. First off, the first issue is, how much technology did China steal in order to get these technologies is part of the problem. But they have it, and so it also pushes them ahead because they have a huge push for engineers, which is definitely going to push them ahead of us in the long run. But the other major issue is that China went from an underdeveloped country to a developed country. And the advantages to that is that if you're in the U.S., if you're in, say, New York City, and so obviously New York is a relatively old city in the United States. Well, it's very old. It's a very old city compared to the rest of the U.S. But if you've got a building that dated back to like the late 1800s to early 1900s, it takes a lot of effort, money, and time to have to go through that building and get it up to date on even easy things like fire codes or water or piping or whatever, like that can be a lot of work. It can be really difficult. As opposed to China, because it's building, everything is being built in the country now, they can just build it to code right now if they so choose. And so a lot of the advancement happens because you have this difference in building new versus trying to rebuild everything. So it's just kind of part of life and how it works, because you're going to have to try and build everything out, but I guess it just kind of is what it is. Yeah, people are spending less money. Anything on the YouTube? Let's see. Don't think I've got a whole ton more. Not really a whole lot of zombie firms. What is a zombie firm? Zombie firms are unprofitable businesses that stay afloat by taking on new debt. I can already tell I'm not going to like this. So my issue with saying this, especially saying there's these zombie firms out there that don't, okay. In political economy, a zombie company is a company that needs bailouts in order to operate, or an indebted company that is able to repay interest on its debt but not repay its principal. Yeah, so that's... Problem is that describes every single tech firm known to man. Right? Because the truth of the matter is, all companies at the beginning are absolutely most of them are going to be unprofitable. It's very, very rare, it's very seldom that you are going to get a company that right out of the gate immediately starts making money. It's just not, it really just is not plausible for every company to start out profitable. Just how it is. Not super worried about that. I avoid democracy now altogether. Let's see. Talk about earnings. It's going to be really interesting. I wonder if he's going to actually land himself in prison. He absolutely deserves to go to prison. Yeah, I would totally avoid that. Okay, when you get headlines like this, okay, look, guys, most of these people are pushing clickbait. They're not pushing actual ideas, okay, because no one really knows. And then, of course, big media gets it wrong. Economics is crazy because the people who should be getting it right are always getting it wrong. Because you have to understand, like, economics is a social science as opposed to a hard science. So, look, in a hard science, if you can shoot a rocket into space, you win. Hey, I get to shoot the rocket into space. You can't prove me that I didn't do it, right? Because I can see it. Everyone else can see it. Awesome, great. You know, Elon Musk shoots rockets into space all the time. Awesome. The issue is when something is invisible, such as economic forces, it can be very, very painful because, you know, if we go into a recession, or if something, you know, for example, if if your wages go down, the economy could actually be doing really, really well. But if you got laid off and now you have to take a job that only pays you 70% of what you were making before, your feelings on the economy are very different than what's actually happening in the economy. So, in either case, Yeah, nothing too crazy going on today, but yeah, we'll keep at it. See what happens tomorrow.